Still with me? Good. Because the next step is where the magic happens. Imagine taking everything you've learned so far and transforming it into something extraordinary. This is the moment when ideas ignite and creativity flows. It's about connecting the dots, piecing together your vision, and unleashing your potential. Think of it as the alchemy of your thoughts, turning raw concepts into polished gems. Embrace the process, experiment boldly, and don't shy away from failure. It's just a stepping stone to success. This is where you find your unique voice and make an impact. So, let's dive in and create something unforgettable. Over 70% of investors under 30 are making a critical mistake that could cost them their financial freedom. If you're banking solely on savings or diving into high-risk stocks, you might be setting yourself up for failure. The truth is, wealth isn't just about what you earn, it's about how you manage it. Diversification is key. Instead of putting all your eggs in one basket, consider spreading your investments across different assets, stocks, bonds, real estate. This strategy not only mitigates risk but also opens up multiple streams of income. Remember, it's not just about chasing the next big stock, it's about building a solid foundation for your future. Are you ready to rethink your approach? Investing in dividend stocks is like planting a money tree. First, look for companies with a solid track record of paying dividends, think blue-chip stocks. Check their payout ratio, ideally, it should be below 60%. This means they're not overextending themselves. Next, consider the dividend yield. A higher yield can be enticing, but beware of yields that seem too good to be true, they might signal trouble. Diversification is key, don't put all your eggs in one basket. Lastly, reinvest those dividends to harness the power of compounding. With patience and strategy, you can build a reliable income stream that works for you, even while you sleep. Imagine owning a piece of a company that pays you just for being a shareholder. That's the magic of dividend stocks. These investments are like having a reliable income stream flowing into your pocket, regardless of market ups and downs. Each quarter, you receive a portion of the company's profits, no selling required. It's like getting paid to hold on to your investments. Some companies have been doing this for decades, creating a legacy of wealth for their shareholders. So, while others are anxiously watching stock prices fluctuate, you can sit back and enjoy the steady cash flow. It's a smart way to build wealth over time, and who wouldn't want a little extra money coming in regularly? Imagine this, you're sipping on a Coke, scrolling through your favorite Apple device, and you realize these aren't just brands, they're also your ticket to financial growth. Companies like Coca-Cola, Apple, and Procter & Gamble aren't just household names, they're dividend-paying giants. That means they share their profits with you, the investor. Even if you're just starting out, you can tap into this wealth-building strategy. By investing in these companies, you're not just buying products, you're becoming part of their success story. Picture receiving those dividend checks while you enjoy your favorite soda or use your latest gadget. It's like getting paid to enjoy life. So, why wait? Start exploring dividend stocks today and watch your money work for you. But wait, what's the catch? Why doesn't everyone do this? Let's uncover the hidden truth. You see, while it sounds enticing, there are layers to peel back. Many people overlook the risks involved. For instance, the initial investment might seem low, but hidden costs can quickly add up, leaving you in a financial bind. Plus, the time commitment is often underestimated. It's not just a quick fix, it requires dedication and consistency. And let's not forget about the competition. If it were that easy, everyone would be doing it, right? The reality is, success demands more than just a good idea. It takes strategy, resilience, and sometimes, a bit of luck. So, before diving in, ask yourself, are you ready to face the challenges that come with it? Chasing high dividend yields can feel like a gold rush, but it's a trap that many fall into. Picture this, a company boasting a juicy payout, but behind the curtain, it's drowning in debt or struggling to stay profitable. Those eye-catching dividends? They can be a smokescreen, masking serious financial issues. Remember, high risk often leads to high loss. Instead of chasing the biggest payouts, focus on the stability of the company. Look for consistent earnings and a solid business model. Protect your investments by being smart, not just greedy. Avoiding traps in life can be easier than you think. First, always stay aware of your surroundings. This means being mindful of the choices you make and the influences around you. Second, set clear goals. When you know what you want, it's easier to spot distractions that lead you off course. Finally, practice saying no. It's a powerful tool that helps you maintain focus and prioritize what truly matters. By following these 3 steps: awareness, goal setting, and assertiveness, you can navigate life's challenges with confidence and avoid falling into common traps. Step 1. Dive into the dividend yield. This is where the magic begins. A yield between 2% and 5%? That's your sweet spot. It's like finding the perfect balance in a recipe. If it's too high, it's a red flag. Think of it as a warning sign that something might be off. Too low? Well, that's just not worth your time. You want to invest in companies that reward you without taking unnecessary risks. So, keep your eyes peeled and remember, a solid yield is just the beginning of your investment journey. Stay sharp and make informed choices. When evaluating a stock, one crucial step is checking the payout ratio. This figure reveals how much of the company's profits are distributed as dividends. Ideally, you want this number to be below 70%. If it's above that, it's a red flag. A high payout ratio means the company might be sacrificing its ability to reinvest in growth. Think about it: if a company is giving away too much of its earnings, it could struggle to innovate or expand. So, keep an eye on that payout ratio. It's a key indicator of a company's financial health and future potential. When evaluating a company, financial health is your compass. Dive into revenue growth. Are they consistently increasing their sales? Next, check their debt levels. A manageable debt-to-equity ratio is crucial. And let's talk dividends. A company that has paid dividends reliably for a decade? That's a strong signal of stability and commitment to shareholders. It shows they're not just chasing profits but are also focused on rewarding investors. Remember, a solid financial foundation can weather storms and seize opportunities. So, keep your eyes peeled for those key indicators. They're your best friends in making informed investment decisions. Still with me? Good. Because the next step is where the magic happens. Imagine taking everything you've learned so far and transforming it into something extraordinary. This is the moment when ideas ignite and creativity flows. It's about connecting the dots, piecing together your vision, and unleashing your potential. Think of it as the alchemy of your thoughts, turning raw concepts into polished gems. Embrace the process, experiment boldly, and don't shy away from failure. It's just a stepping stone to success. This is where you find your unique voice and make an impact. So, let's dive in and create something unforgettable. Building a dividend portfolio is like constructing a solid tower. Each block represents a stock, and the key is balance. You want to mix reliable blue-chip companies with some growth stocks to keep things dynamic. Think about sectors too. Diversifying across industries protects you from market swings. Look for companies with a history of increasing dividends. These are your sturdy blocks. And don't forget to reinvest those dividends. It's like adding more blocks to your tower, compounding your returns over time. Remember, it's not just about the yield, it's about creating a sustainable income stream that can weather any storm. So, stack wisely and watch your portfolio rise. Diversification is key to a resilient investment strategy. Imagine a pie chart, where each slice represents a different industry: technology, healthcare, utilities. By spreading your investments across these sectors, you're not putting all your eggs in one basket. If tech stocks take a hit, healthcare might still thrive, keeping your portfolio balanced. It's all about reducing risk. When one sector struggles, another can step in to stabilize your returns. So, embrace diversification. It's not just smart, it's essential for long-term growth. Your financial future deserves a well-rounded approach. Dividends are like little rewards for your investment journey, and here's a game-changing tip: reinvest them. Imagine your portfolio as a snowball rolling down a hill. At first, it's small, but as it gathers momentum, it grows bigger and bigger. That's the power of compound growth. When you reinvest those dividends, you're not just adding to your initial investment, you're creating a cycle of growth that accelerates over time. It's like planting seeds in a garden. Each dividend is a seed that can sprout into more shares, which then produce even more dividends. Before you know it, your portfolio can snowball faster than you ever imagined. So, don't just sit back and watch, reinvest those dividends and let your money work harder for you. Imagine starting with just $1,000. It sounds small, right? But here's the magic: if you reinvest your dividends, that initial amount can snowball into something incredible. Picture this: over time, your money is working for you, compounding and growing exponentially. Even with just a few modest contributions along the way, you could watch your portfolio soar into six figures. It's not about hitting the jackpot overnight, it's about the power of patience and smart investing. Every dollar you reinvest is like planting a seed that can flourish into a financial forest. So, why not let your money do the heavy lifting? The journey to wealth starts with that first step. Investing can feel like a thrilling roller coaster, but trust me, it's not all fun and games. First, don't put all your eggs in one basket. Diversification is your best friend. Next, avoid chasing trends. Just because everyone is raving about a stock doesn't mean it's a good buy. Research is key. Understand what you're investing in. And remember, emotions can cloud your judgment. Stick to your strategy, even when the market gets wild. Lastly, don't ignore fees. They can eat into your profits faster than you think. Take a breath, make informed decisions, and watch your investments grow wisely. Chasing after stocks with the highest yields can feel like a gold rush, but let's pause for a moment. It's easy to get lured in by those eye-popping numbers, but remember, if it seems too good to be true, it probably is. High yields often come with high risks. Companies offering these enticing returns might be struggling, or worse, they could be hiding financial troubles. Instead of jumping on the latest trend, focus on solid fundamentals. Look for companies with a history of stability and growth. It's about building a portfolio that lasts, not just chasing quick gains. So, take a step back, do your research, and invest wisely. Your future self will thank you. When it comes to investing, one of the biggest pitfalls is ignoring fees, especially those sneaky charges related to dividend reinvestment. Picture this: you're excited about your dividends, thinking they're all going back into your investment pot, but wait, your broker is taking a slice of that pie. High fees can chip away at your returns, turning what could be a fruitful investment into a frustrating experience. Every dollar counts, and those fees can add up faster than you think. It's like paying a toll every time you want to cross a bridge to your financial goals. So, before you dive into dividend reinvestment, take a moment to read the fine print. Make sure you're not letting those fees eat into your hard-earned money. Remember, it's not just about how much you earn, it's about how much you keep.